Hello and welcome to equities Bank. My name is Jonas Thulin. I'm head of asset management, and I will give you the last update for 2022. So we will be back on the 9th of January 2023. And last week we rolled out our bigger picture view on 2023. This week we will look a lot more on the equity side of things. So without further ado, let's kick off. First of all, track records are what they are a year like this. So yes, 90% of our mandates are beating the benchmarks. And this is our medium risk portfolio versus our index. And you can see that yes, we are on longer term, we're still beating. But a year when we're all down, it's I don't know, it's sort of a band-aid on a very bad wound. So we're constantly working with controlling portfolios. And as a matter of fact, it's quite interesting to see that we didn't fall off as deep as the indices did. We were able to tactically avoid the worst mines, so to speak. But we were not also not rebounding as vividly. And there's a good explanation for that. It's that we tighten reins a bit here and keeping a lot more control in portfolios. And the reason for that is our long-term forecast, our long-term performance are now dipping below what we consider being sort of the normal threshold. So a low-risk portfolio should do 3 to 5%. So we're on 286. The medium risk portfolio should do 5 to 7. We're on 485, and this is rolling 5-year returns. And obviously, when we're dipping below those long-term measurements, we want to control the portfolio a lot more. That's the reason why we're holding off and not sort of chasing the equity market to that extent. On the contrary, or also in combination, I mean, obviously we're still beating on the global equities, global sustainable equities, interest rates, and sustainable interest rates, and also alternatives. But that said, it is still our view that we're going to go into a more normal 2023, normal in the sense of we're hoping for not going to have another war in Europe, and no turmoil in terms of elections in the US, etc., etc. So hopefully we should have that third year of the presidential cycle, which is quite strong for US equities. Blockification will continue, so we still have to juggle this idea of we're going to have recessions and soft landings, but we will not have sort of this very well coordinated slowdown or pickup for that matter that we have been accustomed to before the pandemic. And also we are still expecting 90% recession risk in Germany, Eurozone, obviously already priced, and only 25% risk in the US. 25 is still 25, I should say. So we're not neglecting it, but we're not strategically take positions on this until at least it breaks into a statistically more significant threshold. So a lot of this has already been priced. So we think the risk reward is to follow the hard data, not the consensus. Now, the outlook that we still have is the same macro forecast we presented a week ago with the same risk allocation in terms of assets classes and also the same regional weight, so nothing has changed. So if you pop the hood, the same underlying factors are still in play. This is the same graph I showed last week. We won't go through it all this week. Maybe we should do an in-depth presentation where we actually go through each and derive why we're thinking. What I'm concluding here, but given the fact that we made the outlook last week, this week we'll be looking more on the equity side of things. Obviously, we're still in the camp that we believe they're going to move from a low growth, high inflation to low growth, normal inflation, and that means a huge shift, potential shift for the equity market. It's actually the biggest. Almost the biggest shift you can see that yes, if you went from a high GDP growth and low inflation to a low GDP growth and high inflation, that's the biggest shift on the downside. You can argue that's perhaps what we've seen given the war. But we think to miss a potential like this for 2023 will be quite bad for the portfolios, which is why we're hanging on to the overweight equities that we have. Now, obviously, that all depends on inflation, and this is sort of set in stone, as I've been arguing for the last couple of weeks and months. And now, obviously, we can see this is 2-year data. We can see the US is already pushing lower from the 20 to 80th percentile that we've seen for last year, which is really quite interesting that the momentum has really turned for the US CPI. And obviously, we have had 6 months of lower GDP numbers. So it's not a question if CPI has peaked. it peaked 6 months ago. So it's quite extraordinary how slowly we are in some corners of the market to fully appreciate this idea. And obviously, we shouldn't forget that it was back in March that the fixed income market peaked in terms of inflation. So this is still our base case, obviously. It's on the left-hand side, I just show you what will arithmetically happen to the CPI year-on-year growth number in terms of a monthly, like minus 0.3, minus 0.2, minus 0.1 flat, 0.1, 0.2, 0.3. So it's actually that we have to maintain a 0.3 month-on-month increase in order to be anywhere near the Fed forecasts. So arithmetically, Fed is, I think they're talking tough, hoping not to have to deliver on this. Obviously, we, the US consumer, and almost all rate markets are arguing for you're going to be on sub 3% in 2023. So a huge difference here from Fed forecasts. Quite interesting. Now, obviously, to predict the CPI number, which has peaked back in June, which was our peak in our global equity portfolios, you can use this dark blue line. And what is that then? Well, basically, it's when we trade swaptions in the rate market, where we pretty much exchange inflation with each other. So it's inflation swaptions that we use, and then we can restructure those contracts to end up on the same dates that we get the headline CPI print. If you do that little exercise, you all of a sudden you find out with this right-hand graph. So predicting the CPI number becomes a bit easy in that sense. But it's also quite interesting to look at what the next number will look like, where we think is going to be mid 6%. So we're going to shave off another 0.6, 0.7% on year-on-year growth. So it's a pretty rapid deterioration in CPI. And obviously we can flip that and put it versus equities, and we can play around with the idea that what if this correlation becomes more of a regression? What if we can use this daily updated CPI pricing power to see where the equity market is moving? That's quite an interesting thought. I haven't really done too much work on this, but there you go. It's an idea. Now, obviously, the supply bottlenecks are rapidly deteriorating. The old news, they peaked back in a year ago. So we've been arguing for this for a year now. And you know, at the end of the day, yes, it's a driving factor on the downside for CPI, which is sort of what we've been anticipating. The CPI pressure, if you look at the CPI PPI spread in China, the ISM prices paid, everything is turning lower. That basically means that the rate market is, yes, we acknowledge the peak, but then we're going to turn lower a lot quicker than the Fed is arguing. I won't spend too much time talking about the little hike over there in 2025, but it's more interesting to look at what's going to happen in 2023. Now, that we're going to end up with cuts was obvious from a year ago, before we even started hiking rates. So this is, you know, way before the first hike in March. We always knew that we were going to end up with a massive cut. And this is because the rate market, I shouldn't go into the transitory discussion, but it's quite important to remember that the rollover in inflation, call it transitory, call it whatever, has always been priced in the rate market. Now then we can argue and we can have bitter fights in terms of media context, in terms of Fed saying this or that. At the end of the day, we've always had a priced cut at the end of the cycle, which is very unique for this cycle. It's the first time it's happened. Now, this ends up with this kind of blue wave. If you look at the percentage chances of or probabilities priced into, there you have the meeting. So in May, you have the peak. And then you actually, in the rate market, have a 50 basis points cut going into the year. So something is happening here, which is quite interesting. And I'll come back and show you what is actually happening. But it's very interesting to see this kind of lower yield. And did they move during the Fed meeting? No. Not really. We actually, the blue wave became even more entrenched in terms of cuts rather than anything else, because the language was actually more dovish if you do some math on language by natural language programming. But it's quite interesting to see the rhetoric, which was severely mixed up in my mind with the OPEX on Friday. And we should not confuse the two. So that's why we've been sort of keeping our calm and in order to evaluate the market today and tomorrow especially, before we go draw any conclusions from last week. That means that the current rate hike cycle, yes, we will hike a bit more aggressive, but not as aggressive as in 80, 81 or 70s. And then we were going to plateau and fall lower quite more rapidly than any other hike cycles. And you can actually see that you're pricing in cuts going a year and 2 years ahead in time. And these priced cuts might seem aggressive given the history, but they're not as aggressive than the Fed forecast is. Because remember that in 2024 and 2025, we're going to cut rates by 200 basis points according to the Fed. So they're acknowledging that they will cut rates aggressively. Then it just becomes a timing question. And the market did not budge during last week. The market in Europe did not budge due to Lagarde's so-called hawkish comments. So this is quite important to bear with us and not be confused with equity drop-off that we saw last week, I would argue. Now the peak hawkishness has turned around and we can see more dovishness. This is just natural language processing on versus the equity market versus the rate market. So we're still long US Treasuries, we're still overweight equities. Now importantly, the rate of hikes starting to be priced out mid-October, which is sort of the pivot. The pivot in terms of catching the equity momentum going into Q4. That's over and done with. And what we're now looking at in the February meeting is a quite high probability, over 60%, for a 25 basis points hike. And you're well above 95% if you're looking at least getting sort of 50 or below. So this whole shift in terms of we're not going to hike by 75 basis points anymore, we're going to go to 50, and we're not going to do 50, we're going to do 25. This is really pushing into the rate market, and this is a lot more dovish or pushed forward than the actual language from certain Fed speakers. But do remember that in every Fed cycle, they always tend to like to talk tough in order not to have to deliver. That's the best way to manage the market. And they're quite refined in this. So hats off, but we had to treat it as that as well. Now in terms of financial conditions, we see plateau and rolling off. I made a leading indicator of financial conditions, and I've taken away stripped out equity markets here. And obviously, if I'm right, we're going to have a lot looser financial conditions going into 2023. Of course, the combination here is that yes, rates are moving up, but you can't really see it in spreads or liquidity pricing or counterparty risks. And we also know that there's a lot of cash on board. So the rate hikes are not enough to really kill off the economy by any chance. Now in terms of the equity market, we still see falling vol. We have our vol indicators. We can still see it gapping down. So you have the rate and equity vol. And we also calculate that the number of days that we have, with positive trading days are quite low this year. We can all see that in the equity market. But that said, it's a mean reverting statistics. We believe that we're going to have a move up. And what's quite interesting, depending on what you think where the bottom is the move upwards are a lot more volatile than the moves downwards. If you can see, we're sort of doing the staircase down and we're doing a rocket launch on the upside. And this is what I think we need to remember as well, that if the market turns around, it's going to be a quick move. And we have to be prepared for that in our books, I would argue. And obviously work, as you can see, tightening reins, keeping vol and everything under control. That said, why we're also optimistic is that we can see our data range indicating moving up, i.e. there's a lot of more institutional buyings than on the last hours of the trading day than they are retail, buying and selling in the beginning of the day. And we can also see a change in margin depth. And quite interestingly, when the market is moving lower, equity sentiment is moving higher. And this is traditional pattern on OPEX days. So it's not the first time, it's not the last time. Whenever we have OPEX expiry, this is July for example, you have moves upward in sentiment. So the market has learned to live with OPEX expiry. There's a number of accounts out there that are doing this easy trick of pushing gamma into negative territory. You go out there and you sell and push the market on Thursday, Friday, and then you plateau it on a Monday and you buy back on a Tuesday, turn around Tuesday. This is more of an easy trading strategy that a lot of institutional investors are behaving like, and that's why I think we can see these deviations that you can see that you move up in terms of sentiments and positioning and everything, and no one really is too bothered with the downside on OPEX days. Obviously, given the reasons that OPEX market is, the option market is a lot bigger than the actual equity market for the time being. They sort of push all in this kind of distortion, so that's really the story of last week, I would argue, then, rather than trying to make this more simplistic idea that, oh, Lagarde was probably hawkish. It's not priced in the market, but I still think they're hawkish. That's why the equity market fell down. It sort of makes a rational sense somewhere. It's a lot more difficult, perhaps, to argue that, no, the equity market actually slid down into a negative gamma. So you have all this market makers that has to sell the market because it was $8 trillion worth of options and futures that expired on Saturday and obviously stopped trading on the Friday. And that's what we had to deal with last week. And this is why I think sentiment can move in opposite directions. That was a long explanation on that graph, so I apologize for that. This graph is not pretty, but I want to put it in there, especially for our European viewers and Swiss viewers, in order to remember that the equity market uncertainty as derived from US media, which is in green. So when it implodes, you have a heightened sell-off in the equity market. Right now, it's stable, it's solid, it's constructive. Completely opposite if you do the same readings in Sweden or Europe, and that's worth keeping in mind. I shouldn't go through these other time series, but if it were to turn lower, sharper, I also want to see if it's monetary, fiscal, interest rate, or inflation that's driving vol and equity markets. So we can calculate that. So if the market sort of burns up here in the financial crisis, we know that what time series this was monetary policy that was driving the factor. Lately has been fiscal policy. So it's a bit of a nerd level, but it's always quite interesting to try to understand why the market is selling off in order to find troughs, in my idea at least. I can be wrong, obviously, as many times before. Now, the risk indicator for the US equity market is quite constructive. If you look at rate spreads, CSS, FX, vol, fixed income, volume, money market spreads, actually be more constructive and positive than we've been going back a year. So we have to go back to 2021. So obviously, when we're at these levels in terms of the risk indicator, the equity market is behaving a lot more positive than it has to do now. We're doing a great job catching up in Q4, but we believe there will be more, or this risk indicator has to really collapse any day now, but it isn't so far, which is quite constructive given the flows and everything that we've already been through. Another measurement is what I call, let's see if everybody runs to the same side of the ship. So what I'm really afraid of seeing is that the equity market is turning bearish, and that bearishness is spreading to other markets, or other markets' bearishness is spreading to the equity market. So you get this move that everybody joins and runs to one side of the ship, and that's when this black time series is peaking. And when we break through this benchmark, we know for statistical reason that yes, you're going to have a sell-off in the equity market. Right now, even though the equity market was down Thursday, Friday, no other market is sort of biting the bait. And I think that's really constructive. So we have to really be careful reading too much into that sell-off. And this is a neat way to see how risk is spreading. So I call it internal market risks, and they're well contained. Now, if you look at highs, lows, advanced declines, yes, still an upside. And importantly, do remember that when we have sell-off, as you saw, I haven't updated this since Friday, so I apologize for that. But we have to remember that the fourth quarter is a record fourth quarter. Yes, I mean, there will be days that we're going to see lower the readings, but we have to keep that in sort of some type of context, I think. If we look at the daily trading model that I use, if you look at counterparty risk, dollar liquidity, and vol curves, we can still see an upside. And this is also quite interesting that the sell-off were not sort of transmitted or didn't affect the other markets. So it's quite constructive from that point of view as well. And if you look at flows, you can look at our own flow index, or you can look at Bloomberg's, for example, smart money flow index. I think ours is better. But there's both indicating upside, so increased institutional flows, which is quite interesting. Obviously, we can see that if you look at not what the institutions are doing and try to read it from the market, but also looking at flows in ETFs and funds, and you can see that we have a quite solid period of positive flows going to the market. obviously coming from quite big cash positions that have been on the table. And also quite important to remember that we're in this period now where institutional investors are a lot more optimistic than retail, which is this quote is deriving. Obviously not to the extent they saw in 2020, where real institutions caught on to the V-shaped trajectory some period in April, May. I would argue they were a bit low to the game, or slow to the game, where we were fortunate enough to, knock on wood, where we pinpointed the trough on the 24th of March. But the institutions were quite aggressive in the end of summer, because do remember that's when CPI peaked, and now we go again. But it's probably more interesting when you look at media, or if you talk to retail investors, or if you talk to institutions, that they're really not in agreement. That's pretty much what I'm trying just to illustrate in numbers. The option market is trying to build a trough, which is quite interesting and very important. The liquidity ratio is showing that people are more interested in buying the upside than they are interested in selling the downside. So this kind of cyclical flow indicator in order to derive with this equation, if people are more stressed to not miss up on the upside or chasing the downside, you're definitely on the upside for the time being, which is quite constructive as well. And we also know from behavioral finance that we see this trough, and this is our anticipated and forecasted move in terms of equity allocations, that we have been increasing our equity allocation with lower and lower year-on-year growth. This year, or 2022, has actually been negative. So we estimate that next year we're actually going to see some positive flows going back to the equity market, which is sort of the nature of the game after recessionary periods. And you could argue, depending on how you view things, that 2022 you saw a slight recession in the US. Remember, they had these two quarters. We don't buy into that story, but you could make that argument, which is quite interesting from this context. But anyway, if you then play around with the idea that the rate market is right, that May will be the peak in the Fed, we can actually put the May meeting right here on the vertical line. And you can take 250 days to the left and 250 days going forward, what has happened historically in terms of equity returns. And you can sort of have this clock of going closer and closer to the actual peak in terms of the Fed cycle. So you can see the equity market will rise, and then all of a sudden it becomes a bit nervous the last couple of days, and then you can kick off with the moving up again. And as you can see, this is the mean, and this is not standard deviations. This is percentiles, the 20 and 80% percentiles. But it's quite interesting because this coincides with this macro context that I've been driving for 2023. So it's a factor to be well remembered. If you look at earnings revisions, remember that earnings revisions has been slashed the most they have been in history, actually. So earnings revisions are now troughed, and they have troughed, and price target revisions have troughed as well. And right now they're looking quite good for year-end equity market. We will have to wait and see if that turns, if that materializes. But we will see. In terms of, also remember that in terms of profitability, national accounting profits has already troughed and moved up, which is quite good for 2023 as well. And also do remember that it has been now 2 years ago, almost 3 years ago, that we broke on the upside in terms of global credit cycle. And we're in this kind of global credit increasing world Centix readings, i.e. flows and sentiment in the equity market. And this is completely contrasting to the idea that we had in 2021 when the thing peaked and collapsed, and then obviously we had a war as well. So it's a completely different environment going into 2023, which I think is quite well to remember. Yes, we can see the slowdown in the US. Yes, it's still holding up a very good momentum, so we're in this soft landing camp. We're still on 25 percentage points risk of a recession, so it's not moving aggressively higher than this. It's quite interesting to forecast industrial production, and I will actually not share with you the data we're using, because you can see that it's not rocket science to predict industrial production in the US. And then we can put on sort of a heat wave, so it becomes more and more statistically significant of a recession, and then you're bang on red alert. And you can see that going into the end of 2023, you are in an increased, that's sort of the pinch point of the US economy, and this is sort of with this hold, then we're in a soft landing. If it breaks lower, then we have to go into recession. But do also remember, this is obviously the reason why the rate market has priced in cuts. We believe 25 basis points. The market has put in 50 basis points. So this is how the fixed income market is working. They're already trading what's going to happen in a year from now. The equity market is not looking a year ahead. They're probably looking a quarter, maybe 2 quarters ahead of time. But it's quite interesting to contrast the two, that we can really look at the fixed income market and the macro and say that yes, it's coordinated, it's actually trading alongside and sort of hand in hand. And we're going to have to see how choppy the equity market will be in trying to follow this and come into this realization of peaking yields and cuts from the Fed. So soft landing it is, and we have to see how it develops. For the week that comes up, I think it's important to remember that there will be slower GDP data all across the board, but the GDP data or macro data, both in Sweden and the US, is actually beating the consensus, and that's what matters for the equity market. Now in the US, I actually forgot to put down the PCE here, but we're going to drop off about 0.5 percentage points in year-on-year growth, so we're going to be down to 5.5% year-on-year on PCE. But the 23rd is a really important day. We're going to see orders that has to slow down. China, we had a good meeting over the weekend where you can see more of a growth consensus for 2023, which is quite interesting. Obviously, spinning into the Chinese equity markets. Bank of Japan, they will deliver a flat policy rate, minus 0.1. But also quite interesting over the weekend, they're going to obviously have a new chairman or head of the Bank of Japan from April, and obviously that's going to coincide with a reviewed look at the mandate the Bank of Japan has. And there's some discussion in the market now, maybe increased hawkishness on that. Not too important, or I shouldn't say important, I should say interesting data in Eurozone. Yes, we're sort of pretty much done deal on recession. It's really more interesting to discuss what would happen if we not end up in a recession. And in Sweden, we're going to read the sales, and I will come back to that. So if you start off with the US consumer confidence and orders data, you can see from our order indicator, the yes, you should have a massively lower order data, which probably going to be good in the market to see that the rate hikes are actually biting in terms of the real economy. Consumer confidence in the US will actually tick up. This is the blue with the conference board. There's a huge discrepancy now between this conference board in University of Michigan, obviously given the fact that they ask different questions in terms of inflation. They haven't put in Sweden here as well, but we actually believe a tick up in the consumer confidence data. In terms of this recession in Europe, the ECB would argue that we already are in a recession. I would argue no, we're not. We like to see the daily updated activity data from Germany is actually moving lower. It's not for the time being. So we already have a 90% certainty of a recession. That's obviously what we priced in the equity market this year. But it's a little bit interesting to look at the different now-costing models that are put up by the German Bundesbank and by OECD that are not in line with the recession. And neither is our sort of daily updated data. So IFO might actually not go into recession, might be in this kind of downsizing threshold. But it's really interesting in terms of the equity market, and we obviously loaded up on European equities in anticipation of this because we're already priced a recession, and there are signs they might not happen. The risk reward is pretty obvious, very simplistically put in that sense. And in Sweden, we have retail sales data. Obviously, we now have the worst retail sales on year-on-year performance that we have ever seen. We already knew that before we even started hiking rates. So we were way below the 90s crisis or the financial crisis. And this is all the reason why we should avoid Swedish local companies looking at the Swedish market. But we really like to buy, as you know, we saw on TV this week, like New Wave, which is the biggest market is the US. The other Swedish companies to buy in that sense. We're hiking in an environment where we have record debt service ratio in Sweden, which is quite an interesting combination. I'm quite critical of that, of course. And we used to have a booming economy, and we have a collapsing economy, booming, collapsing, and the policy rate was following in terms of cuts. This time around, we have a collapsing domestic economy, and we have hikes, obviously given the war and the supply pressure, etc. The right policy, wrong policy? I don't know. Given the mandate, it's probably the right. Given that they only have the CPI mandate, it's the right mandate. Nope, they should probably have a broader mandate. A little bit the Japanese discussion they're picking up right now, maybe copying a bit more on what the US is doing. But obviously you need to have politicians to drive this, and I can't see that for the time being, which is a bit of a mistake, I think. That said, on the global equity markets, as I've been pointing out, we're keeping a tight control of things. So we don't want the massive downside. Obviously, we're missing the massive upside, but we need to kill off the vol here a bit. We have diversified away from a lot of the dollar exposures we've had. And you can actually see our strategies there. The average holding period we have on a single strategy, we have about 17 of these in our equity portfolio, 6 months. So we're not too, what you call it, trading intense in that sense. It's sort of a speed that sort of works for us given our mandates. And that's sort of the conclusion for 2022. In the sense why we're still overweight equities and why we're enjoying equities. We can't really see any data pointing us that the stress that we saw at the end of last week will actually be something we have to live with for the remainder of the year going into 2023. And obviously that could be wrong because we still have a year end, but unless we see a tremendous squeeze in dollar funding, which we're tracking by looking at currency basis, etc., we are going to stick to our guns in terms of our allocation. And we will be back on the 9th of January. So I also would like to take this opportunity to wish you all Merry Christmas and a Happy New Year. We'll be back on the 9th of January with an updated view on the equity markets and macro and everything else. So thank you so much for this year, and we will see you in the beginning of next year.